empowering others. So we can't wait to hear from you, sir.
Thank you very much. Very warm good morning to all of you. And namaskar once again. I'm extremely happy to be participating in the fourth annual day event of the FEDI, and I'm extremely happy that we have the participation of Mr. Raghavendra Rao, the president, the chairman of FEDI, and we have the other industry and the financial market associations here who are present here. I also note with a great pleasure the participation of Sri Dinesh Kumar Khara, the chairman SBI, and Srimati Usha Thorat, chairman FDIL and former deputy governor of Reserve Bank. We have the participation of various associations, their representatives, their office bearers like the FDIL, the FIMDA, the IBA, ICC. We have also the CCIL, 81 banks, my colleagues from Reserve Bank of India, and of course, last but most important, the other office bearers and the members of FEDI. Now, our approach over the last 2 years or so been to increase the level of interaction with the market players, the financial market players, and with the other stakeholders in the market. I have always believed, and I have said it earlier also, that a consultative approach always adds depth to the quality of decision making. And I'm happy to say that over the last 2 years, and especially during the period of the pandemic, thanks to technology, we have been able to interact with leading market players, and that has definitely provided us very, very useful inputs, as a result of which we have been able to undertake a slew of measures to deal with this COVID-19 crisis. Many of the measures were proactively undertaken, many of the measures were reactive in nature, but our effort has been to always remain at the forefront to contain the impact of COVID-19 on the economy and on the financial markets. I wish to thank FEDI for inviting me on this occasion. My best wishes and congratulations to FEDI for completing 4 years, and I'm sure it will reach soon a silver jubilee and a golden jubilee, and perhaps move on to reach 100 years. So all my best wishes to FEDI and its members. This is an opportune moment to look back and reflect on the developments of the last 1 year in financial markets, and in particular the foreign exchange markets. I have therefore decided to focus today on the theme accelerating financial market reforms in India. The year 2020 has been one like never before. Faced with an unknown crisis which brought the global economy to a sudden stop, recent policy discourse has been dominated, and rightly so, by the impact of the pandemic. Despite this, regulatory and institutional reforms in the country have moved the domestic financial markets to the next trajectory. Cutting across market segments, these reforms are ushering in a simplified, principle-based regulatory framework that seeks to broad-base markets by easing access, enhancing participation, facilitating innovation, protecting users, and promoting their conduct. Today, I would like to discuss imperatives and the building blocks of the recent reforms, placing them in the context of the big picture of a modern and efficient financial market equipped to support the aspirations of an open and integrated economy like India. Given that we are still amidst the pandemic where the near-term macro concerns dominate the discourse, let me start with a few words on the macroeconomic outlook and the financial market conditions. After witnessing a sharp contraction in GDP by 23.9% in the first quarter of the current financial year, and a multi-speed normalization of activity in the second quarter, the Indian economy has exhibited stronger than expected pickup in momentum of recovery. The global economy has also witnessed a stronger than expected rebound in activity in the third quarter. IMF has accordingly revised its assessment for global growth in 2020 to a less severe contraction than what was originally assessed in June 2020. Even as growth outlook has improved, downside risks to growth continue due to the recent surge in infections in parts of Europe, other advanced economies, and also in parts of India. We need to be watchful about the sustainability of demand after the festivals and a possible reassessment of market expectations surrounding the vaccine. The monetary policy guidance in October emphasized the need to see through temporary inflation pressures and also maintain the accommodative stance at least during the current financial year and into the next financial year. A key source of this in recent months has been the comfortable external balance position of India, supported by surplus current account balances over 2 consecutive quarters, resumption of portfolio capital inflows on the back of robust FDI inflows, and sustained buildup of foreign exchange reserves. The government's recent policy focus to enhance India's participation in global value chains, including through production-linked incentives for targeted sectors, can leverage on the strong external balance position of India. Financial market developments is an important thing that I would like to highlight next. Let me now turn to financial markets. The domestic financial market conditions were benign at the start of the year, but witnessed severe stress and dislocation as the COVID-19 pandemic unfolded. Thinning out of activity impacted market liquidity. Increased volatility of financial prices was observed across most asset classes. Yields hardened in the government securities market, and the yield curve steepened sharply amidst concerns about fiscal slippage and sustained sell-off by FPIs. The financing conditions in the commercial paper and corporate bond market also deteriorated, reflecting overall market conditions as well as generalized risk aversion. The rupee sharply depreciated with increasing volatility and heightened forward premium. The Reserve Bank acted proactively and nimble-footedly to ease financial market conditions and mitigate risks with a slew of conventional and unconventional measures. Market participants responded with alacrity, and together we have been able to ensure stable and resilient markets across all segments. The Reserve Bank remains committed to fostering orderly functioning of financial markets as well as and will continue to evaluate incoming information having a bearing on the financial markets and will act as needed to mitigate any downside risks. Over the last 3 decades, the pace of financial market reforms has gathered momentum, albeit occasionally interrupted by financial crisis. A calibrated opening up of Indian economy has occurred since the 1990s. Alongside, the institutional architecture has been deepened, keeping in view the specifics of the country context. In the interregnum, the markets have also traversed a long distance. Over the years, the bond markets in the country have become broad-based in terms of participation, availability of a variety of instruments, and development of repo and derivative markets. The sovereign yield curve now spans up to 40 years and provides a stable pricing backbone for the development of the corporate bond market in India. The foreign exchange market has also come a long way with increasing diversity in instruments and participants and a growing integration of the economy with the global economy. Alongside these changes, significant improvements in market infrastructure have taken place, encompassing state-of-the-art primary issuances, state-of-the-art primary issuance process for government securities, an efficient and completely dematerialized depository system within the central bank, electronic trading platforms, trade reporting, and central counterparty settlement. Even as the financial markets evolved, some imperfections became evident. Secondary market liquidity in government securities increased, but was confined to a few benchmark tenors. The participation base grew, but diversity of views remained limited, with predominance of buy and hold and long only investors. Interest rate derivative markets grew but remained limited to one product, that is, overnight indexed swap, and to a small set of participants. Domestic foreign exchange markets also grew, but so did offshore markets, fragmenting the global market for the Indian rupee and impairing market efficiency. New product development remained constrained, in part due to limited participation and also due to regulatory restrictions which had developed in response to the past experience with complex products and concerns about valuations and mis-selling. Meanwhile, episodes of misconduct and abuse in global markets raised the imperative of moving governance frameworks, of improving governance frameworks to preemptively safeguard domestic markets. But notwithstanding these imperfections, the resilience and strong foundation of financial markets nurtured over time also presented an opportunity. Markets with small number of participants, as all of you know, tend to become closed user clubs with predictable and behavioral attributes. Furthermore, speculative flows in thin markets, and this is something which all of you know quite well, speculative flows in thin markets can create distortions. In deep markets, these very flows can add liquidity and make the market more resilient. A calibrated opening up of the economy can supplement domestic savings and keep finance growth and help finance our growth requirements and development. Against this backdrop, the Reserve Bank has taken several steps to usher in next phase of reforms to accelerate the pace of liberalization. The recent reform measures, many of which are in the works, have been fashioned around four major themes. One, liberalizing the financial markets and simplifying market regulation. Two, internationalizing financial markets. Three, safeguarding the buy side, that is focusing on user protection. And four, ensuring resilience and safety. Let me now discuss each of these themes. My effort would be to explain the rationale behind each of these measures which the Reserve Bank has taken, and also to place them in a broader context of our overall policy measures. These decisions should be seen in the context of a broader approach that we have with regard to market regulation and market development and maintaining financial stability of the system as well. First, let me focus on liberalizing financial markets and simplifying market regulations. The broad approach driving the recent regulatory initiatives is that any person with a need to access markets should be able to do so with ease at minimum cost. Principle-based regulations for interest rate derivatives and foreign exchange derivatives aim at achieving this broad objective. Detailed procedural prescriptions have been replaced with basic principles, thereby allowing greater operational flexibility for market participants. Earlier restrictions on design of derivative contracts and cancellation and rebooking of foreign exchange derivatives have been dispensed with. Distinctions based on residency have been removed or reduced, bringing foreign participants at par with domestic entities in terms of market entry and exit, while retaining the existence of underlying exposures as the basis for access. Greater flexibility and ease of hedging have been brought in by allowing anticipated exposures to be hedged. Users with small and limited hedging requirements have been allowed to enter into contracts equivalent of $10 million without the need to establish the existence of underlying exposures. Simplifying regulations and providing procedural flexibilities have also contributed to easing operating conditions and thereby reducing costs and inefficiencies. While some operational constraints are inevitable, especially those warranted by prudential considerations, our approach has been to ease operating conditions within these broad considerations. Another example of this is the recent passing of the bilateral netting of Qualified Financial Contracts Act 2020, which addressed an important operating constraint. And in fact, this is something which the chairman of FEDI also referred to. The absence of legal recognition of bilateral netting had discouraged the use of derivatives for effective risk management. The legislation provides the enabling framework for cash and derivative market transactions to be offset. This will enable optimization of capital requirement for financial institutions and will provide an impetus for development of the derivatives market in India. Let me now focus on the second theme of our second component of our broad approach, that is with regard to internationalization of the financial markets. Internationalization of financial markets can lower transaction costs with efficiency gains. Over the last 3 decades, India has undergone a transformation from being a virtually closed economy to one that is globally connected and open to a much larger volume of international transactions and capital flows than before. Today, the capital account is convertible to a great extent. Inward FDI is allowed in most sectors, and outbound FDI by Indian incorporated entities is allowed as a multiple of their net worth. The external commercial borrowing framework has also been significantly liberalized during 2019 to include more eligible borrowers, even as maturity requirements have been reduced and end-use restrictions have been relaxed. Foreign portfolio investment in Indian debt market has been expanded within calibrated macroprudential norms. Limits under the medium-term framework for investment by FPIs have been gradually increased and procedures have also been rationalized. A voluntary retention route, VRR, has been introduced, which provides relaxations from macroprudential controls, but subject to a minimum retention period. In a major step towards greater internationalization, the fully accessible route, FAR, was introduced, under which non-residents can invest in specified government securities without any restriction. Capital account, and this is very important, capital account convertibility will continue to be approached as a process rather than as an event, taking cognizance of prevalent macroeconomic conditions. A long-term vision with short and medium-term goals is in fact the way ahead. As a major milestone towards opening up of markets, banks in India have been permitted to deal in offshore rupee derivatives markets. The measure is expected to reduce the segmentation between onshore and offshore markets, apart from reducing volatility and cost of hedging. Banks have also been permitted to undertake foreign exchange transactions beyond the usual onshore market hours, thus fostering real-time market activity. In a complementary measure, exchanges and banking units in the GIFT City have been permitted to undertake over-the-counter, that is OTC and exchange-traded rupee derivatives. The third aspect I would like to highlight, as I had mentioned, is with regard to the safeguarding the buy side, that is user protection. Safeguarding the interests of the users, that is the buy side of financial markets, is an imperative, especially in the context of liberalized markets and introduction of newer and more sophisticated products. A number of initiatives have been taken in this regard, a few of which I would like to mention. With a view to providing greater protection to less sophisticated users, a user classification framework segregating users into retail and non-retail has been introduced for OTC foreign exchange and interest rate derivative transactions. Retail users can be offered only non-complex derivative products, while product innovation has been permitted for non-retail users as per their business needs. The issue of fair and transparent pricing of foreign exchange products, especially for MSMEs and other small users, has been occupying our attention. Market makers are now mandated to separately disclose fees or charges when dealing with retail users. Also, an anonymous order matching electronic platform called FX Retail has been launched by the Clearing Corporation of India, CCIL, at the behest of the RBI. This platform allows users with small transaction sizes to undertake transactions at best available market rates. These measures are expected to ensure greater transparency and protection of retail users. Concerted efforts by banks will be required if the benefits of transparent and competitive pricing are to reach every user of foreign exchange markets. Derivative markets As derivative markets are liberalized, market conduct needs to be strengthened through robust assessment of product suitability and user appropriateness. Regulatory requirements in this regard are being reviewed in consonance with the overall changes to the regulatory approach. And this is something which is in very advanced stage, and we should be able to finalize it quickly. Let me now finally turn to the focus on the fourth area of our approach, that is ensuring resilience and safety, after which I would conclude. Financial market infrastructure in India has remained resilient even during various financial crises. Learning from international episodes of market failure, several further initiatives have been taken to ensure continued resilience. Fair market conduct is critical to ensure efficient functioning and preserving trust in the financial ecosystem. Hitherto, conduct codes prescribed by market bodies like FIMDA and FEDI FIMDA and FEDI guided market participants in financial markets. To supplement and strengthen these, please note, to supplement and strengthen these, a regulatory framework for market abuse has been put in place. The idea is not to replace not to replace what FEDI and FIMDA have done, which is seen to be very useful. That is our experience. But the idea is to supplement what FEDI and FIMDA have done. We have put this regulatory framework for market abuse in place. The Reserve Bank has been taking measures to implement the G20 over-the-counter derivatives market reforms. In line with global trends, electronic trading platforms have been brought under regulatory purview to ensure efficiency of operations and address systemic risks. A draft framework for variation margin for OTC derivatives aimed at reducing counterparty risks from non-centrally cleared derivatives has also been recently issued. And this was referred to by the chairman of FEDI. And we will be carrying further, this is work in progress. And once the comments, etc., are received from all of you and from other stakeholders, the RBI will issue the necessary guidelines. Global efforts are underway to put in place a legal entity identifier, that is LEI, which uniquely identifies financial market participants' aggregation of risks. Reserve Bank has also mandated the use of LEI for participants in markets it regulates. In fact, we are one of the few countries that has implemented the LEI beyond derivatives market to cover transactions in government securities and money markets, as well as the credit market, that is especially with regard to the large loans. A key issue which has been engaging global attention is the transition from the LIBOR to alternate reference rates. In India, several measures have been taken to make financial benchmark procedures more transparent and robust. More recently, the administrators of significant financial benchmarks were brought under regulation to ensure robust governance frameworks and process controls. These reforms will stand us in good state as we prepare ourselves for the LIBOR transition. The Indian Banks Association has been working closely with the market participants to facilitate the transition to alternate benchmarks and create customer awareness. Achieving a smooth transition from a benchmark entrenched in the financial system will require significant efforts from all stakeholders. And this is one area, I think, where associations like the FEDI and others have an important role. The FPIL also has to play an important role. And I'm happy to say that officials and our teams are constantly engaging with you. And I think this vibrant and this interaction, this process of interaction will definitely make the process of transition very smooth. Let me now just conclude all that I have said. I have attempted today to set out the broad themes which have guided the liberalization and reform agenda for financial markets. The recent changes are aimed at enabling financial markets to enhance allocational efficiency in the use of resources and thereby contribute to economic development. With this freedom comes responsibility. This is very important again for all market players, for all market participants. The achievement of the desired outcome is, however, contingent on financial institutions and market participants taking forward the reform agenda so that we have vibrant financial markets and efficient financial intermediation. The simplification and flexibility provided in the regulation must reach the end user. In designing new products and new market segments, risk management systems and responsible market conduct should evolve in tandem as we open up to global players. Market participants and their associations, including FEDI, will have to play a critical role in this. I will stop here. Thank you very much for your patience.
Thank you so much, sir, not just for your presence, which means the world to us, but for actually explaining everything so meticulously to the T. I'd like to now request once again our chairman, Mr. Raghavendra Rao, to please come on this virtual stage again.